Hey, I got a setup that just hit my system here a few minutes ago. So, if you want a trade setup that has 7 wins and 0 losses over the last 3 years, then you're going to like what I have to share with you. My name is Joshua of CounterVest, and let's get right into it. So, let's talk about Walmart. Now, why Walmart? My approach to trading, without going too much in depth of everything that goes into it, is if you compare it to football, it's situational based. I look for situations that set up, wait for that situation, and then take advantage of that setup there. So this is one here with Walmart. There's a setup on this one where we've talked in previous videos where I talk about selling what the industry calls a bull put spread. It's a gimmick name. It's just selling a put and then buying something lower at a lower strike to reduce the cost and reduce your risk as well. You can even use a naked put if you prefer, but for this one, we're talking about what's known as a bull put spread. Anyways, this setup has happened 7 times over the last 3 years, and it's been a winning trade for an overall gain of about 140%. So looking for situational based setups like on each stock will happen only certain times. This is why you want to set up. This is why you want an algorithm to run and to make you aware of these situations that do happen, but they're not situations that are going to happen with that a fund's going to be able to take advantage of. A fund that needs to put money at work, a hedge fund, the big boys. This is the difference between the little guy and the big guys. The little guys can wait for opportunities to arise. The big guys can't wait. They have to take advantage of things, and they need to put money to work right now, if not yesterday. So what we do here is we wait, we look for setups. So this is a setup that we've talked about previously in other videos, but it's essentially just fading the move here. We get a sell-off here, and I've talked about this phenomenon called an institutional bid. You get sell-offs, and then all of a sudden, in these big names, these highly followed indexes, these stocks that are heavily followed in indexes, like Walmart, you start to see this institutional bid coming in, this money put to work by institutions. So I'm not going to point every time it's happened, but just take a look here at the eye, or take a look here at each time. We get the sell-off, bam, rip higher. We get a sell-off here, we rip higher, and we get another sell-off. So it seems to be where we get a pretty aggressive move lower, and then we get a bit of a move higher here. So the difference between buying call versus selling a put is that we have time and we have volatility working in our favor. Now, with the put spread, we do offset that because we're buying something. We're buying a higher implied volatility, which the skew goes against us, but we're doing that as a trade-off for less capital risk on that position because theoretically, the stock can go to zero. Walmart, not necessarily going to happen. I don't think there's an equity risk where Walmart's going to go out of business, but we could see something where Walmart could accelerate lower because maybe there's a supply chain issue. There could be something else going on there, but the reason why you would buy something lower on a put is to reduce the risk, the overnight risk. But there are a trade-off there. Without going to options 101 or 102 with you, is what we're looking at. So volatility overall is elevated here. So if you bought a call, even if prices rise, that call would come down in price because the volatility would get sucked out of it. And if prices don't necessarily soar higher, then we're stuck with an option and we bought something here. So what I'm looking at here is I'm helping you set up for this. So what we're looking for on this one, on a confirmation, what I'm looking for is we try to get above here and we weren't able to. But once we break this 200, we got to close above it. That's when we initiate the trade. And the trade I would be looking to do here, before we get into that trade, just make sure I cover my bases here. We have volatility here. We have an oversold condition. And that's what we're necessarily going for. The RSI isn't necessarily something that is exact, meaning that it's going to turn right now, but we can kind of see a little bit of a rotation, a little bit of the ease, which would also help with selling some premium because we're selling time and we're selling volatility here. So if volatility comes in on our put and we do get prices that go higher, that helps that position there. So what we're looking at here, well, what I am looking at would be something in the 25-day cycle at this point. 25-day, and you can even go into the 32-day. So depending on what you want here, I would look a little bit on where I could get filled at on a better price here. So we have about some pretty good spreads here. You got to work a price here. So decent spreads. It depends on what you want to do here. But I would be looking to sell something in, and how this system would work is you look at a static approach. So it's selling something in the 40 delta range, so the 138 put, and then specifically buying something maybe at the 135. So buying 138 and buying 135. So it really depends on how much risk you want per spread. The bigger the risk, the more premium you get, but you need to manage that. And a lot of people want to sell, let's for instance, the 138 by 136. Well, that sounds great. You get 2 points, and let's just see what this would sell for. You get 58 cents. Somebody would say, okay, that's great. Well, you're risking about $1.40 to make 60 cents, and you want that premium to be able to manage it, because what we're looking to do, the reason why this has a high success rate is not letting it go to expiration, is because we're managing it, this one around 50%. So we take in, if I took in $1 on this, I'd be looking to take it off at 50 cents on this one. So that's why you want to make sure you get something that has some something to squeeze on it, because you want to be able to manage that profit here. So if you just took a 3-point spread, and there is more risk here, theoretically, because it is 3 points of risk that we have here, but we have 80 cents. So this is where it gets a little interesting, because that's the reason why we have to play around with this. You know, we sell the 138, which looks interesting, but then we have to buy something lower here, and you can see here the implied volatility is going against us. So because that skews against us here, the premium is elevated on these out of the monies, because if something were to happen, the velocity is much greater to the downside than it is to the upside. So these will expand here. So what I'm looking at here is playing around with this, trying to figure out something after that confirmation, what can play out here. As I mentioned, let's say, okay, 138, 134. And if I could get this at $1 here, we have $4 of risk. Well, essentially we have $1 we take in, we have $3 of risk here, so it's a 3 for 1, but the probability of this is a high setup here for that to play out. So that's what I'm looking at here, and this is the trade-off. I mean, we could look at something on the dollar side for the same price, for instance, in this 25-day, and you can play this 143, but we just take a look at the delta here. At this point, this has a 30% chance of making at least a penny or more. So it's a very low probability bet. This is a low probability versus a high probability. And also we're looking to just follow the system that has provided us a back-tested result that we can lean on and have confidence in as well. So that's what I have for you. Again, the confirmation on this one will be above the 200-day moving average at this point. Happens tomorrow or the next day, look for that, fade the trade, and to continue to move higher here. But again, it's not something you hold to expiration. You take the premium, you manage the premium, whatever you feel comfortable with, and then you get out and move on. It's not taking this to expiration, because there's a lot of risk. So until next time, good trading, and we'll talk to you then.